Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you can come to learn how to take apartment buildings and turn them into amazing communities. So, hey guys, I have a great guest here, someone that I thought would be very relevant for the time that we're going in. His name is Dan Kennedy, not the marketer Dan Kennedy, but he is still a marketer, but not the marketer Dan Kennedy. He's Dan Kennedy, the principal at Driven Capital Partners. Very excited to have him on. I am your host, John Brackett. Dan, welcome to the show, man.
Well, John, thanks for having me, man.
You're very welcome. Okay, so let me invite our audience into this conversation so they have a better feel for who you are. And then I'm going to give them really kind of a summary of where we're going with this conversation, just to keep everybody engaged as we walk through this. So Dan has actively invested in real estate since 2011, focused on well-located investments in strong cash flowing markets from California to Texas. So in 2017, Dan began investing his single family residential portfolio into commercial real estate assets. And since then, Dan has been heavily involved in syndications in different parts of the country, with an emphasis in areas such as Santa Barbara to Texas and to other Midwestern and Southern states, buying not only industrial product, but apartments as well. So one of the reasons why I thought Dan would be a great guest on the show, because they not only invest in apartment buildings, but they also are repositioning assets such as office buildings and purchasing industrial product for yield. So Dan, welcome to the show, man.
John, thanks for having me, man.
Okay, bud, I appreciate that. So hey, give us a sense for how you got into this space. What's your story, man?
Yeah, so, well, I played professional soccer for 12 years in Major League Soccer. And I was fortunate to have a career that long. And I was never great enough to make a lot of money while I played. But the money that I made, I was just focused on getting cash flows, because I knew my short career was coming to an end. And all I wanted to be able to do when I retired from playing was not have to go take some job that I didn't want. I wanted to be able to go and pursue something that interests me, rather than going and just being an employee. And so, as I was winding down my career with the Galaxy, I went to business school at USC, and that's when I've created a single family home portfolio of passive income rentals throughout California and Texas. And I was exposed to syndications with a couple different family offices that were operating, that I got connected with through USC's business school. And I just thought, I had this moment where I just knew my network of professional athletes needed this more than any other investment vehicle, just because your career as an athlete is short. And
right.
when you're done, you fall off a cliff from an income perspective. And what you need is passive income. And 401ks, IRAs, these vehicles don't help athletes when they're retiring at 35 years old.
That's a great point.
So one of my best friends, Matt Seamus, he's also my partner. He was at Facebook at the time. Similar investment story. We were sharing notes as we value added residential plays. And he was ready to leave Facebook. Same time I was leaving Major League Soccer. And so we started Driven Capital Partners. And Matt his wife works at Google. They have a very strong network of trusted friends and family as well. And so we started this shop 3 years ago with a focus on preserving capital and creating passive income and growing wealth for people through real estate investing. And so that's predominantly how we started. And now we have over 110 investing entities with us, and we have about 500 people that follow what we do and are interested in what we're doing. And we, our strategy today, post-COVID, has changed a little bit, but we're fortunate enough today to say that all of our assets are performing really well. And we've invested in predominantly in value add apartments and industrial warehouse. And those are two assets that over the past 20 years have performed really well, even during down cycles. And so that's why we were kind of focused on those two asset classes to begin with.
Okay, awesome, man. I really appreciate that. So this is going to be a great conversation. What I'm going to do is, just because of the broad-based knowledge that you have and what you're investing in right now, I think the timing is really good based on where we are in the cycle, right? So what I'm going to do is start off by walking our audience through the cycle of a real estate acquisition, right? So
Yep.
we're going to start with an acquisition. We're going to talk a little bit about that in the markets, some perspective there. Then we're going to move through capitalizing that asset in this marketplace, so financing, debt and equity. Then we're going to go to management, whether property management or asset management, right? If you're outsourcing that. And then finally, we're going to talk a little bit about dispositions, because I think right now we're in a cycle where we're starting to get more trades, right? So that's going to be pretty important. Now, before we get into that initial conversation around acquisitions, one of the things that I really appreciate you talking about is your experiences as a professional athlete, and wanting to understand how to transition into a field that you absolutely love, right? And are passionate
Yep.
about. Well, one of the things that I hear people talk about constantly, and usually there's a fear when making a transition into any industry, right? There's a little bit of doubt, there's some reservation. So it's kind of neat, because as an athlete, and I was one too in college, so I get this, you're constantly having to deal with fear, right? And finding ways to get to the other side of that. And one of the easiest ways to do that is through training, right? Repetition. Well, a lot of our audience out there, and I'm hearing this and seeing this on different mediums, is the conversation around transferable skills, right? And the reason why I think it'd be great for you to share, what were the top 3 skills that you felt you were able to transfer over to real estate investing that help accelerate your success, because that's going to resonate with a lot of people and help a lot of our listeners out there and our viewers out there understand how to leverage the skill sets that they currently have to make a transition, right? Whether
Yep.
it be investing passively or stepping in as an operator and starting to build a portfolio themselves. So with that being said, Dan, can you talk a little bit about that, the transferable skills?
Yeah. Well, I was I was never the most talented guy on any team on the field. And so what I always fell back on was hard work. But before hard work, it's not just about working hard, it's about working smart. So you have to have this ability to kind of tighten screws and grind. I've always had that. It's just who I was as a kid. It was in me innately to go and just grind things out. I always felt like I could go outwork the guy next to me. And so that's one thing that's easy for me to do. And one thing that today I have to be more conscious than ever of, because I have young kids and a family, and I could go grind all day trying to build this business, but I have to be conscious of how I'm utilizing my time. But so if you have the element of hard work, then it's about putting together a plan that can lead you to success. And in sport, it was, I always use the example of fitness, because if you want to be financially fit, you don't get to just go and take one class and learn something and become financially fit over one time. It's the same thing with working out, John. You're not going to go and on January 1st, go have a huge workout and then be fit for all of 2021. This is something you have to be consistent at. And some days your workouts are going to be crappy. And some days you're going to break through some barriers and you're going to have great workouts.
Right.
But it's about having the plan to be consistent. So what we try to do is be consistent with the type of return that we're chasing and underwriting, and be consistent with the type of deals that we want in the markets that we're chasing them in, and then give our investors the same opportunity to act consistently to give them the best opportunity for success over a long period of time as well. So now we're working hard. Clearly, it's a requirement. We have this plan in place to be decisive over the steps that we're taking, to be diligent. And then in the end, I'm an entrepreneur. As an athlete, I don't think I was great at any one thing, but I was a good leader. And if you're going to go syndicate deals and you're going to have your own shop, this is where leadership is required, especially on the asset management side, because you need to be able to lead your property management team. That's who's working for you. And John, if you've done apartments for long enough, we use third-party property managers. The reality is they will let the property stagnate if you are not on top of them. We have at Driven Capital Partners have created so much value just by leading our property managers. And then on the flip side of that, who are the relationships of the people that are supporting our business, the investors? We also need to lead them because they're not the real estate expert. And so when COVID happens, what are we doing from a principal's perspective to communicate to our investors, and then to try to evaluate what's happening in the marketplace, and then to devise a strategy from where we're going on the acquisition side, and then also what we're going to do to sustain what we already own when shit's hitting the fan, literally.
Right.
So those are the pillars that I kind of think about when I think about the crossover, the transition from being an athlete to business, and the skills that I have that I want to play to my strengths with, is definitely, if we go backwards, we go leadership, and then goal setting, and driving some strategy on the goal side. And then you always have to fall back on working hard, because it's not, in these deals you envision some outcome, some return, but you know how hard it is to make money. These things are not going to be given to you. You need to go and take them.
Actually, man, I think making money is not very difficult once you are clear about, once you're clear about how to do it, right?
Right.
There's a process in place for creating value.
And this is actually a critical point you're making.
Yeah. Go ahead.
And you're referring to our business model. Is we understand a business model where we know we can go make money, not for ourselves or just for ourselves, but for our investors too.
Yeah.
And that's actually what was the catalyst to me stepping away from sport and into this business, was understanding the business model and falling in love with it.
Yeah, but not only the business model, man, but the markets are here in the United States are predictable, right? Because we have monetary policy. So one of the cool things about the US, and I love this country, is that with all the liberties that we have here, so long as those liberties are protected, right? And we still have the ability to pursue them. Democracy is an ideal, man. Okay, democracy is an ideal, and it's our responsibility to maintain the ideal, right? Well, same thing as in business. Okay, business profits, they come down to an ideal, right? It's just an ideal. It's an idea or a thesis, as a lot of people like to term it in school, but we can go out and we can pursue it and execute it, right? Well, fortunately, to your point, if you've done something enough and you've made money doing it, there's predictability behind that. The other side of this in this country is because of how debt is injected into this country, our markets have predictability behind them, man. They're fairly predictable.
Right.
And so I think with those two things, or some understanding around those two things, creating value or money, right? Money is simply the inverse of value, right? So if we looked at value or money as currency of value, easier to quantify. One of my good friends used to say, hey, John, man, if you're not happy with how much you have in your bank account, it's because you're not adding enough value. And I never forgot that. And that was several years ago.
Right.
But same thing. So there is predictability. So I'm going to tell a really quick story, because you said something, man, that I really love. Actually, everything that you said, but the top three things were consistency, intentional action, and the third one was leadership, right? So you're one of the few that's come on and has spoken directly about leadership. And so that's awesome because I think it's a reflection of who you are and then what you're doing every day, right? Because you're right, that's a huge value add component. But I'll tell you a really quick story. So when my freshman year in college, I wrestled in college, right? Everybody in there was either a state champ, All-American,
Right.
some kind of place winner, right?
Right.
And so first year, man, I got absolutely worked. Okay. And I would
That's
always,
lesson of your life.
yeah. So I always was able to fall back on my work ethic, always, even today. But what that experience taught me was, working hard wasn't enough because at that level, everybody is doing it, right?
Right.
So in this space, in our industry, okay, you have a lot of All-Americans, right? You have a lot of state winners and you have a lot of state place winners, right? You have a lot of people that can perform. So that year I said, okay, well, I'm tired of getting worked, okay? Because the technical skill was just much more advanced than mine was, especially when you have All-Americans in the room, right? They were technicians. They were more technical than I was. So that's where I learned, man, that, I had to shift from just being a grinder to someone who was intentional about how I worked out and make sure I was working on the right things.
Right.
And I started focusing on technique.
Right.
Right. So even with my kids today, I tell them, look, all things being equal, if everybody has the same mental toughness, same physical capability, the person with the greatest technical skill is going to win. Be a technician and someone who can just work through challenge, right?
Right.
Those two things are critical.
Yep.
So you said that, man, and I think that's a great point. Hugely, I think, undervalued is it's really important to have a really strong work ethic, but you have to be a technician in the trenches to be able to.
Right. No, there has to be a plan. There has to be a plan behind the work. You can't just go run around like a chicken with your head cut off. That's for sure.
Okay.
And I've been guilty of that.
And we all have, and that's business, right? We got to constantly adjust. Okay, Dan. So I'm gonna pivot a little bit. That's a great frame to start the conversation around acquisitions, right? So talk to us a little bit about the strategy to diversify yourself. Even though this is a show around apartment buildings, I think it's great that you're going to add a unique perspective that's going to add some context into why you guys have chosen to diversify yourself into industrial product, and especially in this marketplace, right? So can you talk about that a little bit, and then we'll pivot into financing?
Yeah. Well, there's so much uncertainty in the world. Today is election day. We have COVID. The rates are starting to pick up across the country. And as investors, we want predictability. We want to try to understand what we think a property is going to do tomorrow or in 5 years from now. And when we look at our experience with apartments, what we've been able to do from 2017 to pre-COVID to the beginning of this year is very consistently project rents and market rate rents and loss to lease and all of these variables. And with COVID as an element in our world, there's just more unpredictability to that underwriting. And so we have taken time to try to see if there's been maybe an adjustment in seller expectations. And maybe there really hasn't been up to this point. But we also feel like now 6 months have passed. The markets that we're pursuing apartment acquisitions in have fared really well. We already have properties in those locations. We already have great relationships with brokers for deal access and property managers to go and take over. And so when we're looking on the acquisition side, our deals are still coming through our network connection, through very warm relationships. And it's, hey, this guy's he's 86 years old. He's decided to sell his entire portfolio. He's got 5 multifamily assets in Santa Barbara. Why don't you underwrite them all real quick and come up with a couple fair market values for him and get some offers out before this ever touches the market. Right. So we go and tour the properties. We sent out 3 offers on out of the 5 buildings, and we got 1 in contract today. And it's your typical value add apartment story. Property has literally not been touched in probably 30 years. It needs an extensive rehab. probably like $70,000 a door. So extensive rehab.
Right.
But rents are 45% below market. I mean, there's people that are enjoying rents at that place that are almost unthinkable. But when you walk in the units and you see the condition of them, I think it's irresponsible to let people live in them with the condition that they're in.
Right.
And so we're going to utilize AB 1432, the bill that says if you substantially renovate the building, you can legally and lawfully have people leave because it's going to be a construction zone.
Sure.
So that's a little bit of a glimpse into the value add apartment game that we're chasing. And then on the flip end, because we're starting to ramp up the apartments again now that we feel like we have a little bit of better understanding of where these rents are going and these submarkets that we're interested in. But in the interim, we had already been processing industrial warehouse investments and simply chasing yield. So John, if you're my investor, what we're trying to achieve for you or any of our investors is a diverse income stream through investing in commercial real estate. Well, we can achieve diversity through investing in different markets and different asset classes. And the one thing through COVID that was very consistent and has stayed consistent is the performance of industrial warehouses. And so we pursue industrial warehouse acquisitions through the Midwest, as you mentioned, through the South. We have a building up in Boise. And really, once you understand the local market metrics, the most important thing in any acquisition on the industrial warehouse side is then the tenant. And so we spend a lot of our time underwriting the tenant and getting to know the tenant before we buy the building.
Okay, so a couple of questions there, right? So the first question that comes to mind is, why not just continue to pursue, apartment buildings in markets that would be perceived to have a little bit more risk? So secondary, tertiary markets, right? Because then your yield would, in theory, go up versus, diversifying yourself away from apartment product into industrial warehouse product for yield, right? So what was the driver behind that decision? Was it a deal flow opportunity, or what was the driver?
So our first acquisition, we had about $75 million of deals lined up in February of 2020. Our first acquisition did not happen until the end of June, and it was a $3.5 million industrial warehouse deal in Boise. And so if just rewind a few months, and we were in this world where we didn't know how hard apartments were going to get hit. And now we're kind of understanding that high urban dense filled areas are getting hit the hardest. Your New Yorks, your San Franciscos, your downtown LAs, Chicago's, those markets are really getting hurt in the apartment space. But yeah, we are underwriting apartments again in places like Huntsville, where we have what we think is a competitive advantage from a relationship perspective with brokers. But these buy cycles, they take time. So if we we literally paused all apartment acquisitions until July, and then we started pursuing again, and we've bought one in Santa Barbara. We're in contract to buy another one in Santa Barbara, and then when we get to the disposition conversation, we're selling some apartments in Huntsville, Alabama. So it's this year's just been it's been so fluid in how we're kind of pivoting and trying to adjust and analyze, and it's just been easier for us to underwrite industrial warehouse deals. So that has just been, if you think about the deals are just competing horses in a race. And we're always underwriting, a handful of deals at a time and trying to pick a winner. And today the winners just have been industrial, but I don't expect that to be the end all be all for us.
Okay, cool. So I appreciate that. So Dan, let's pivot into financing a little bit, right?
Yep.
Debt and equity. So talk a little bit about how you're financing your projects currently. What does that look like?
So we'll utilize brokers from, let's say, Walker Dunlop, or George Smith Partners, if we don't feel like we can take care of the debt piece on our own. I mean, we're a 3-year-old company, still relatively new. Getting folks comfortable with us, having these debt brokers helps expedite those relationships with lenders. Our first approach is always in market. So if we're going to buy in Milwaukee, we're going to a local lender in Milwaukee. They typically understand the fundamentals of the submarket a little bit better. The first bank we always reach out to is the bank of the tenant in these industrial warehouse deals. Because you think about it, no one knows the tenant better than the bank.
Sure.
And if the bank is like, yeah, we would love to do a loan on that property, it's usually a pretty good sign that the tenant is prospering as well. And
that's actually good.
Yeah, it's just a good little trick of the trade, and it's not a new idea, nor is it my idea, but it's a space that we try to exploit. And again, relationships, right? So we're going through some tenant improvements on our medical offices in Huntsville, and we're getting a line of credit from the bank who did the original loan on the property because we have a tenant in tow. It's going to drive incremental value through the new lease because it was vacant space when we bought the building, and so we're lending again from the same bank in order to improve the property to allow a tenant to move in. And then on the equity side, I mean, we raise small checks. We have investors coming in anywhere from $25,000 to $200,000 a check. And we typically give ourselves 30 days to raise the equity on any given deal. But we've, so quite surprisingly during COVID, when we rolled out our first deal, I was a little bit nervous on how it was going to go. And we were able to raise, I think we set out to raise 1.6 million, and we raised 1.9 million from our current investors within a couple of days. So we've had a lot of really positive traction on the small check side of things.
And then how are you structuring the equity on that for most of your opportunities?
Yeah, so we try to do a 75-25 split after a 7 or 8 pref, and the deal typically dictates our preferred return. So in these industrial deals, if the cash on cash return in year one's has a 7 in front of it, then we do a 7 pref, and then a 75-25 split after that. And then we typically have a hurdle at whatever our projected IRR is. So let's just say we're projecting a 15 IRR. Anything after a 15 IRR, we do a 50-50 split with our investors. And, we charge a nominal acquisition fee and asset management fee. And these, the beautiful thing about syndications and structures is in the end, our incentives are aligned. The better the property does, the better the principal is going to do, and vice versa.
Sure. Okay, awesome, man. I appreciate the summary there. So now we are going to shift a little bit into asset management or property management. Do you outsource property management, or do you have your own management?
Yeah, we outsource all property management
to
third-party property managers, and we just build it into our underwriting. And this is, for Matt and I, this is how we scale. I mean, we are the 2 guys that run this shop, and we have contractors that we work with for bookkeeping. Our tax advisor plays a very valuable role within our business almost on a daily basis, along with our real estate attorney. But with that being said, we're lean and mean. So what we want to do is we want to pay a third-party property manager to be on site, to take care of the little nitty-gritty things. But what we've learned over time is that the most important thing that we do is have a weekly call with them to make sure that they are understanding what our strategy is and delivering on that end. Because if we let that go quiet, then oftentimes months start to pass before you can lease up a vacant space at a medical office, or the turns on your apartments in Huntsville are taking 3.5 weeks instead of 2.
Okay, so let's talk about that a little bit, because asset management really important, right? Especially if you're outsourcing that. So for our listeners out there and our audience out there, we have 40% operators, the other 40% are passive investors, and we have those folks that are looking at figuring out how to take their transferable skills, like we talked about at the beginning of the show, and make
Right.
that transition into either being an operator or a passive investor. Okay.
Right.
So with that being said, if you had to list maybe your top 3 metrics that you've learned to really dial in when you're onboarding a new property manager, what would that look like? What does the conversation look like for you from a leadership standpoint when
Yep.
you're first making that interview and of course looking to onboard a new management company? And then the top 3 metrics that you focus on in that first 90-day period.
Yeah, well, we want someone who's smarter than us in the end, So we love Boise for their growth story that's happening right now, and we bought a little flexi industrial warehouse building up there with just an amazing tenant in place. And we interviewed, I think, 3 or 4 property management companies, and we wanted. It's actually great for underwriting to understand what they thought with an unbiased opinion, what the operating expenses should be for this building. So it helps us, right? It helps us in our underwriting. So we use the interview process to let them pitch us a little bit on, okay, this is, historically what your property level expenses should be. It's triple net lease property. It should all be billed back to the tenant anyway. But it helps us understand the market a little bit better. And then they need to get granular and talk about the experiences that they've had. How are they creating value for the money that they're making? Do they have in-house plumbers, electricians, servicers, right? If they do, that could be a cost savings. And then in the end, right after we acquire the property, and straight into the bookkeeping and accounting, we want to see a P&L and a balance sheet every single month. We work off of work order systems, so every single bill that the property has, we want to see an invoice for it. And that's to keep people accountable. And then after we onboard the kind of the accounting of the property, then it's just a check-in and make sure that they at least have touch points with the tenants. If the tenants are having any problems, we know about it. And that allows us as the owner to either play good guy or bad guy.
What do you mean by that? Good guy or bad guy?
So we want our property managers to have great relationships with the tenant. And sometimes we need to make decisions for the financial return of our investors. And so we're going through a sale transaction right now, of which we have some leases turning over in the apartment building. And one of the tenants is at like $700 a month and the market rate is $925. Well, she should be renewing at $925. And in this case, because we're going through a transaction, we actually just don't want her to leave the building. We just want to keep everything status quo. So we're moving her to month to month. So in this case, we're the good guy. The policy would be for the property manager to go to her and say, hey, market's $975. We have to at least get you to $850 to justify you staying here. And that's not our policy. That's the owner's policy. So then I'm the bad guy in that scenario, right? So we can waffle on why we're doing certain things, but typically we step in and we say, hey, on renewals, this is our expectation. Mm-hmm. On new leases, this is our expectation. And if you're having an issue with the tenant, then let's devise a strategy to get them out. And if you, the property manager, need to look like the good guy, then blame it on me.
Hey, so, here's something that I've kind of learned over the years, and it's one of the reasons why we created our own property management company, is culture. You have competing cultures, right? When you're dealing with a third-party property management company.
Correct.
And as you start to scale, it becomes very, very difficult to scale when you're having to sell someone on a culture that's competing against yours, right? Because their profit metrics are very, very different in yours. In theory, they should be aligned, but what makes it very challenging is I always say that if you're working with a third-party property manager and you're looking at a P&L, the challenges that you're having in your P&L managing that property will show up in your P&L, and it's a function of cultural dysfunction, right?
Yeah.
The competing cultures. So when you
Yep.
talk about leadership, that's why I was really pleased to hear you talk about leadership, because the only way to effectively deal with the competing culture with a third party property management company is leadership, right? It's getting them to buy into the vision culturally first, and then of course following that up with the metrics to help sustain that profitable culture, right? Depending on how you communicate that. So from your standpoint, what does that look like, right? When you're communicating to a third party manager, your culture and you trying to get them on board with that?
Yeah, we have an apartment complex that we had a cultural collide in the first year with the property management company. And the strategy we devised was incentivizing them on the performance of the property. Yeah, the property management fee, they were actually getting 10% because it was 24 units. And so it was just market. That's for under 100 unit complex, it was just market.
Right.
But we had repositioned and invested our money into the building. It wasn't their money that they invested in the building to create better net operating income.
Sure.
And 18 months passed and the property was 30% more profitable and they're still clipping 10%. And that's when I just had to raise my hand and I said, hey guys, we got to adjust this because we've invested all this money into the building. It's now churning out more of a profit, but you guys are capturing so much of that value. And really it was our GC that did the work. It wasn't your property management company. So we need to adjust expectations. And that was not well, as you can imagine, it was not well received. But what we did was to provide them with the data that even at 8%, they were going to make more money that year than the previous year at 10%. And then it became palatable, right? And so I felt like we drove a little bit of synergy. Another instance is in Santa Barbara, we're trying to create a critical mass of housing. And so what we have worked with a third-party property manager with is that we work with one person on all of our properties. And so it's a big property management company. They have a variety of employees. What we want is one employee that can deploy the same strategy across all of our assets. And that becomes a little bit easier for us to manage because now I only have one point of contact.
Yeah, no, that's very wise.
Right. And so now we get to work and we may build up a critical mass up enough to where she is only working for us. Right. We are paying her entire salary. We don't want to Matt and I don't want to own a property management company. That's not what we're setting out to do. So I can already see us saying to this property management company in Santa Barbara, we're effectively going to pay for this employee. We want to hire somebody else on your team and we'll pay for them. Right. But now talking about aligning incentives and strategy and getting cultural buy-in. In the end, John, you and I are going to go work together because we have some trust and some mutual understanding of what we're trying to achieve. And so that's kind of how I see the relationship over time with our third-party property manager in Santa Barbara is that we're going to have alignment because we're going to make them money and we're going to build their business right along with ours.
Okay. Awesome, man. Awesome. Well, hey, bud, we are approaching the end of our show. And Dan, I want to thank you because this has been a great conversation. You've shared multiple perspectives. And I think some of the key takeaways really are about the transferable skills that you've been able to communicate back to our audience. And the top three are the importance of being, not only just having a work ethic, but being consistent, right? Small, consistent daily singles, man, I like to call it.
That's right.
The second thing that you shared was being intentional with your action. Okay.
Right.
Don't do like what I did as a freshman going into a room with a bunch of All-Americans and I did not change my strategy, nor did I refine my technique, but that was a really good lesson learned. And of course, now I'm a real big believer in you gotta be a technician. And then lastly, you touched on leadership and then you gave some great examples of what leadership looks like in our world, right? Whether it doesn't really matter the asset class, but in this case, apartment buildings, you did a great job of communicating some of the cultural challenges that can be overcome, especially with property management or asset management for that matter, with very good leadership, right? And so I appreciate you, man, for being on the call. Lastly is your insights into how you folks have been able to play in different asset classes, right? To be able to not only improve yield to your investors, but also diversify yourself away from some concentrated risk. And I thought that was pretty cool. So, man, I want to thank you for being on. You've been a tremendous guest. Hey, what is the one question that you have for me that you feel can add some value to our audience? Then I'm going to ask you to please share how our audience can get in touch with you if they have some questions or want to learn a little bit more about what you do.
Yeah, well, I'm always interested in what I consider smart people like yourselves are thinking about the next 18 months. If you had $100 or $100 million, where do you, and you had one bet to make, where are you putting your money?
Okay. Let's see. If I had one bet to make, where would I put my money?
I hope it's not Bitcoin, because then I guess I'm out of a job.
No, it's not Bitcoin. Here's what I would do, right? With that money. And, you know, a really good friend of mine, one of my good friends, also a mentor, man, he's a little bit older than I am, or in this case, much older. He's probably almost 80 years old now, right? Maybe 75 or so. But I remember he invited me into this group in Las Vegas, and he's been working with these guys for probably like 30 years, and they do a lot of exchanging. And, you know, he invited me out there to meet his group, right? And so I was really honored, man. It was a great opportunity for me. And truthfully, I've walked away with just the exposure to actually how deal makers do deals totally changed my world, right? Because those guys are deal makers, man. They've been doing it for 30 years. The things that they do at the time, I just was totally unaware that you could actually do that stuff, right? Mm-hmm. And so it really broadened my perspective. But we were roommates together, okay, in this hotel. And so one of the things that he shared with me, he said, John, I'm going to show you the formula for making millions. I'm not even going to charge you for it. And I started laughing. And actually, true story, not only do I still have the email, I have the document that he gave me. The paper was on like a yellow pad, right, that he wrote it down. Yeah. Like I should find it, man, and post it.
You should frame it.
I didn't frame it, but I kept it. But he said, look, first, 10% put back into education. Yep. So with that money that you talked about, the very first thing that I would do, man, is bet on myself.
Yep.
That's worked for me really well over the years, but I would take a really good portion of that and figure out, what do I need to invest in? What kind of learning do I need to invest in to help get me where I'm trying to go next year? That's a huge one. And I'm doing that right now. I'm going through that process right now for next year, right? And then secondly, the way that I would place that money now is really two things: is apartment buildings, right? Because I built some mastery in there and I understand that product well, to be able to be a technician. And then the other component of that is notes, man. I really like notes. Yeah. Always have, still do. I lend out a lot of my own money in, you know, notes secured by a first deed of trust. But I think there's an opportunity, and I see that now, to be able to, you know, purchase notes, right? So I think we talked about this a little bit, right? If you are lending your money out and, you know, that money is being secured by a first deed of trust and you're at 65% loan to value, but you can purchase the note at a discount, at a 15% discount, well, you help drive your yield, one, right? But you also put yourself in a position where if it's a product that you understand and you're comfortable with it, if for some reason you have to take that asset back and it's in a very similar business that you're in, much easier to mitigate against that risk, right?
Right. You go
much easier
by operating it.
Mitigate against that risk. And so especially if the payoff is right around the corner, then that's an added bonus, because if you're buying a note where, you know, someone needs to get out from that for whatever reason, they need liquidity. Banks in this market are fairly liquid, so that's a very different story. But I think there's some really good opportunity there, but predominantly with private lenders, because right now they're going through some liquidity challenges, And so I see that as a really good opportunity, man. And I think the more capital you have, the more you can play in that world and do fairly well. So that would be my comment, or my feedback rather.
Well, thank you. Thank you.
Yeah.
Yeah, I love the note and then lending space as well. And it's just complementary to what we do in general.
It really is. It really is. And, you know, I think it's a great way to be able to keep your money active, right? Drive cash flow and still stay in a space that you can underwrite to and understand, because if for whatever reason, you know, you have a default and you have to take back that asset, right? To make sure that you can liquidate that so that you don't lose any money, that you can pay yourself back, right? I think it's just easier to underwrite to risk that you already understand. And so that's one of the reasons why I do that. So, hey man, I want to thank you for being on the show. Really appreciate having you on, and I want to wish you continued success, bud.
Thanks, buddy. I appreciate that.
Anytime, man. Thank you. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.